In the architecture of modern power safety protocols are never simply forgotten, they are deleted, deliberately. On December 30, 2025, while the American public was sedated by the lull of the holiday season, a kill switch was quietly flipped in Washington. There was no press conference. No breaking news alert interrupted your dinner. But the structural damage inflicted that Tuesday was more precise and more devastating than any foreign cyber attack on the power grid. For the first time since the ashes of the 2008 collapse settled the single entity standing between your life savings and systemic institutional fraud, the Consumer Financial Protection Bureau was effectively taken offline. Do not mistake this for bureaucratic incompetence or a simple budget dispute. This is a calculated suffocation. The Office of Management and Budget didn't just trim a spreadsheet, they severed the jugular of financial oversight. As I record this, federal investigators, agents sworn to audit the books of trillion-dollar banks, are literally sitting on their hands. They have been legally barred from accessing the operating funds, required to inspect a single ledger, a single document, or protect a single document, or protect a single document. The watchdog hasn't just been chained to the fence, it is being starved to death in plain sight of the neighborhood it was built to protect. Ask yourself the uncomfortable question, why now? Why at the exact moment consumer debt is piercing all-time highs and the shadow of a 2026 recession looms over the bond market? Would the government choose to blindfold its own police force? We are not witnessing cost-cutting, we are witnessing the preparation for a historic wealth transfer. To understand who is about to be liquidated, you only need to look at who just fired the security guard. This is the death of the watchdog. To truly grasp the magnitude of a systemic collapse, we must first look away from the billion-dollar headlines and focus on a single microscopic fracture in the economy. We will construct a profile. Let us call her Bianca Jones. She represents the median American financial participant, a mid-level marketing manager, a consistent taxpayer with a 720 credit score and a 30-year fixed mortgage. Bianca is not a speculator, she follows the rules. But in the first week of January 2026, she notices an irregularity, a nebulous servicing adjustment fee of $420 added to her escrow account buried on page 4 of her monthly statement. In the financial ecosystem of 2 years ago, this scenario had a predictable mechanical resolution. Bianca would log into the consumer complaint portal. She would upload the PDF. Within 15 days, the bank would receive a notification stamped with the federal seal of the CFPB. The reaction inside the bank's compliance department would be immediate and driven by fear. The cost of a federal investigation far outweighed the profit of a $420 fee. The bank would calculate the risk, rescind the charge, and issue an apology letter, the system imperfect as it was functioned because the threat of consequence was real. That reality has been deleted. Fast forward to the morning of December 31, 2025. Bianca spots the same error. She dials the hotline. She is greeted by the same automated voice, but this time the queue leads nowhere. Inside the agency, the enforcement officers who would normally handle her case are physically present at their desks, but they are legally paralyzed. Due to the OMB's funding freeze, they cannot initiate a new inquiry file without violating federal spending laws. They are, quite literally, paid to watch the phone ring, but forbidden from picking it up. The bank's algorithm, however, is fully operational. The institution is aware that the watchdog has been muzzle-loaded. When Bianca disputes the charge, now the calculation has changed. There is no fear of a federal audit. There is no risk of a penalty. The bank denies her claim, citing an obscure clause in the user agreement that she never read. When she refuses to pay, they don't apologize. They compound the interest. They report the delinquency to the credit bureaus. Her score drops, her borrowing power evaporates. Now expand this single isolated data point by 100 million. This is not a story about bad customer service. It is the deliberate reintroduction of information asymmetry into the American marketplace. The architecture of modern finance is designed to be complex, specifically so that the user cannot understand it without help. For 15 years, the government provided that help. By removing it, the administration hasn't just saved a line item on a budget. They have fundamentally altered the power dynamic. The institution possesses the data, the high-frequency legal teams, and now total immunity. You possess nothing but a debt obligation. The tragedy here is not just the loss of protection, but the transfer of cost. The narrative sold to the public is that cutting the CFPB saves taxpayer money. This is a mathematical lie. The cost of corporate fraud does not vanish when you fire the police. It is merely transferred from the state's balance sheet to your personal bank account. The $420 fee that Bianca is forced to pay is effectively a new tax, levied not by the government, but by a private corporation that no longer fears the law. You are now operating in a zero-sum game where the referee has been removed from the field and the opposing team has been told there are no fouls. Your only defense is to understand how this referee was created in the first place and why the old money has been trying to kill it since the day it was born. To understand the brutality of the execution we are witnessing in 2025, we must first reverse the timeline to the crime scene that necessitated the victim's existence. September 2008. For the younger generation, 2008 is a chapter in a textbook. For those who lived through it, it was a revelation of a structural rot. When the subprime mortgage market vaporized, wiping out $11 trillion in household wealth, the American public asked a simple question. Where were the police? The disturbing answer was that the police were actually working for the robbers. Before 2010, consumer protection was fragmented across 7 different federal agencies, including the Federal Reserve and the Office of the Comptroller of the Currency. But these agencies operated under a fatal conflict of interest. Their primary mandate was bank solvency, keeping the institutions alive. If a bank was ripping off customers to stay profitable, the regulators often looked the other way because profitable banks are stable banks. The system prioritized the health of the host over the parasite that was feeding on it. Out of this wreckage, the Consumer Financial Protection Bureau was engineered. It was the only significant structural reform to survive the lobbying shredders of the Dodd-Frank Act. It was designed with a singular radical DNA. It would not care about bank profits. Its sole client was the user of money. And it worked. The data is indisputable. Since its inception, this agency has forced the financial sector to return billions of dollars to defrauded Americans. It didn't just levy fines, it pierced the corporate veil. When Wells Fargo employees were found to have opened millions of fake accounts under real customers' names to hit sales quotas, it was the CFPB that levied the historic $100 million fine that broke the scandal wide open. When payday lenders tried to trap low-payment workers in 400% interest rate cycles, the CFPB wrote the rules to stop the bleeding. This track record is exactly why the agency has a target on its back. But the true reason for the current assassination attempt lies in its unique genetic code. The architects of the CFPB anticipated that Wall Street would eventually buy enough politicians to defund the agency, so they built a failsafe. Unlike the FBI or the EPA, the CFPB does not rely on Congress for its annual allowance. Instead, it draws its funding directly from the earnings of the Federal Reserve. This was meant to be a cloak of invincibility, making the watchdog independent of political blackmail and lobbying cycles. This independence is what the current administration and the banking elite have labeled as rogue. They have inverted the narrative. They argue that because the CFPB does not beg Congress for money, it is unaccountable to the people. This is a sleight of hand. By cutting off the agency's access to Federal Reserve funds, the administration is not restoring accountability. They are breaking the specific lock that was installed to keep politicians from looting the security budget. We must view the financial system as a biological organism. The banks are the muscles, the currency is the blood. The CFPB was the immune system, the only component designed to hunt down and kill toxic cells before they become tumors. By shutting it down, the administration is not trimming fat. They are deliberately inducing an autoimmune disease in the American economy. They are betting that the host is strong enough to survive the infection. History suggests they are wrong. But to understand how they managed to kill an unkillable agency, we have to look at the weapon they used. It wasn't a law, it was a loophole. In the theater of political warfare, the most effective assassinations are the ones that don't look like murder. They look like administrative errors. The dismantling of the CFPB was not achieved through a grand debate on the Senate floor. There were no televised hearings, there were no votes. Instead, the administration utilized a weapon far quieter and more lethal, the signature of a bureaucrat. The man holding the pen was Russell Vought, the director of the Office of Management and Budget. His specific move was a masterclass in the dark arts of the executive branch. Under the law, the CFPB requests its operating budget from the Federal Reserve, and the OMB director is required to sign off on the transfer, a task that for 15 years was considered a mere formality. But in late December 2025, Vought simply refused to sign the paper. This was a bureaucratic chokehold. By withholding that single signature, the administration effectively bypassed the entire legislative branch. They didn't need to repeal the Dodd-Frank Act. They didn't need to convince Congress that consumer protection was bad. They simply turned off the oxygen supply. We must look past the headlines to see the fingerprints of a larger machine at work here. This move aligns perfectly with the mandate of the newly formed Department of Government Efficiency, led by Elon Musk. While the public branding of Doge is cutting waste, the reality for the skeptical observer is far more specific. This is not efficiency. This is strategic deregulation. The goal isn't to make the referee cheaper. The goal is to remove the referee from the field, so the game can be played without rules. By framing the CFPB's budget as waste, they justify the removal of the only federal agency that stands in the way of frictionless corporate profit. The impact inside the agency was immediate and catastrophic. Picture the scene. On Monday, you have federal examiners preparing to audit a major credit card issuer for hiding interest rate hikes. On Tuesday, those examiners are recalled. Travel budgets are zeroed out. Investigations that took months to build are paused indefinitely. It is the literal halting of justice due to a lack of paper. The agency has been forced to prioritize its remaining scraps of cash solely for essential functions, which in government speak means keeping the lights on in the hallway while the crime scene in the vault goes uninvestigated. This is the textbook execution of the Starve the Beast strategy, a political tactic that dates back to the 1980s. The playbook is simple, but devastatingly effective. First, you cut the funding to a government agency to make it dysfunctional. Second, when the agency inevitably fails to do its job because it has no resources, you point to that failure as proof that the agency is incompetent. Finally, you use that incompetence as the justification to abolish it entirely. We are currently in phase 2. The administration is manufacturing a crisis of competence. In 6 months, when complaints are piling up and scams are rampant, they will not say, "We caused this." They will say, look, the CFPB doesn't work, let's shut it down. This is a self-fulfilling prophecy of failure, engineered by the very people who claim to be fixing the system. The beast isn't dying of natural causes, it is being starved in a cage, and the key is in Russell Vaught's pocket. But while the executive branch tightens the noose, a third player has entered the arena, and they are arming themselves for a constitutional war. While the agency suffocates in silence, a thunderous collision has occurred in the federal courts. We are no longer discussing budget allocations, we are witnessing a full-blown constitutional crisis. On December 30, the judiciary was forced to intervene in what can only be described as an emergency triage for the rule of law. The U.S. Court of Appeals for the District of Columbia Circuit didn't just issue a ruling, they issued a rebuke. In a frantic legal maneuver, the court ordered the administration to release the funds immediately, explicitly stating that the OMB's justification for the cuts, a claim that the CFPB had no need for additional money, was factually baseless. The judges saw through the veneer. They recognized that the executive branch was not managing the agency, but actively attempting to nullify a law passed by Congress without the consent of Congress. This is the definition of a power struggle. On one side, you have the legislative intent of the Dodd-Frank Act, which explicitly mandated an independent watchdog. On the other, you have an executive branch utilizing the power of the purse to rewrite legislation it dislikes. It is a stress test of the American separation of powers. But for the investor and the citizen, the legal nuances are a distraction from the tactical reality. The administration knows they might lose in court. They do not care. This is a strategy of delay tactics. In the world of high finance, time is the most valuable commodity. The legal battles of this magnitude take months, often years, to snake their way to the Supreme Court. While the lawyers draft briefs and the judges deliberate, the banking sector is operating in a gray zone. This is a window of regulatory twilight where the rules exist on paper, but the enforcer is in a coma. During this interregnum, the smart money moves fast. We are already seeing the deployment of financial products designed to exploit this specific window of immunity. Complex debt instruments, variable rate loans with opaque triggers, and algorithmic fee structures that would normally be flagged by a healthy regulator. The banks know that even if the funding is eventually restored by a Supreme Court ruling in 2027, the profits made in 2026 are theirs to keep. The penalty for breaking the law during a blackout is effectively zero. The backlash is building, but it is fragmented. State attorneys general and consumer advocacy groups are scrambling to fill the void, filing amicus briefs and threatening state-level lawsuits. They see the storm coming. They understand that without a federal umbrella, the consumer is exposed to 50 different variations of predatory lending. But a patchwork of state laws is no match for the centralized trillion-dollar machinery of Wall Street. The key insight for the intellectual observer is the mismatch of velocity. Lawfare is inherently slow. It deliberates. It appeals. It pauses. Markets are fast. They execute. They compound. They liquidate. By the time the Supreme Court finally decides the fate of the CFPB, the damage will be irrevocable. The financial products designed to trap the middle class will have already been deployed, signed, and securitized. The legal system may eventually declare that the watchword should not have been shot, but a court ruling cannot resurrect the dead, and it certainly cannot refund the billions of dollars that will be siphoned from the American public while the gavel is still in the air. The legal battle is a spectacle. The real horror show is what happens next, when the market realizes that the sheriff has left town for good. As we move into 2026, the financial horizon is not just cloudy, it is being deliberately obscured. When the cop on the beat is effectively fired, the market doesn't just slow down, it mutates. We are entering a transition period, where the guardrails of the last decade are being dismantled, and the vacuum left behind is being filled by the ghost of 2000H. The most immediate danger is the return of the toxic loan. Without the CFPB's ability to repay rules and strict oversight of mortgage systems, we are seeing the quiet resurgence of non-qualified mortgages and complex products like balloon payment structures, where a borrower pays low interest for a few years before a massive, unpayable lump sum comes due. In an environment where the agency has paused its supervision of mortgage lending, these predatory models are no longer a liability. They are a profit center. But the Wild West isn't just happening on Main Street, it's happening in your pocket. The digital finance frontier, fintech apps, buy now, pay later schemes, and the crypto ecosystem is the new primary battleground. For years, the CFPB worked to bring these shadow banking entities under the same transparency rules as traditional banks. Now that progress has hit a wall. As the agency's funding evaporates in early 2026, investigations into hidden account access fees, predatory interest rates in digital wallets, and algorithmic discrimination in lending are being shelved. If you thought inflation was stealing your wealth, wait until you see what unregulated fee structures do to your savings. In a world without oversight, a zero-fee app can easily pivot to siphoning pennies from every transaction. Knowing there is no one left to audit their code, even the way debt is collected is turning aggressive. The CFPB once held the line against zombie debt collectors who hounded people for expired or non-existent obligations. With the agency's enforcement division paralyzed, expect a return to the boiler room tactics of the past. Constant harassment, illegal threats, and the seizing of assets without due process. The bank isn't just coming for your money. They are coming for your peace of mind, and the federal hotline is officially dead. The systemic risk here is far greater than individual loss. We are witnessing the reaccumulation of bad debt at a scale that mirrors the run-up to the Great Recession. Consumer protection is not a luxury. It is a stabilization mechanism. When you remove it, you allow the credit cycle to inflate beyond its natural limits, fueled by deception. The collapse of the CFPB is not just a political headline. It is a leading indicator. It is the sound of the structural supports being removed from a building that is already vibrating from the wind. History teaches us that when credit standards weaken, a crash is not an if, but a when. The key insight for the survivor is this. We are returning to the era of caveat emptor, buyer beware. But there is a cruel irony in this return. In 1920, buyer beware meant checking the horse's teeth. In 2026, buyer beware requires you to understand the high-frequency algorithms of a trillion-dollar bank and the fine-print loopholes of an AI-driven lending platform. You are being asked to bring a knife to a nuclear war. The information asymmetry is now absolute. The institutions have been given the green light to prioritize profit over people. If you are still playing the game by the old rules, you have already lost. The system is no longer designed to protect you. It is designed to harvest you. And as the sun sets on the era of federal protection, the only person left to watch your back is the one in the mirror. The dismantling of the Consumer Financial Protection Bureau is not merely a dry headline in a legal journal or a political trophy for a new administration. It is a signal flare rising over a darkening landscape. The shields have been removed. The rhetoric of efficiency and slashing bureaucracy is the mask. The reality is the cold mathematical necessity of the elite. For the modern financial system to generate outsized gains for the few, it requires a steady supply of losers among the many. The only entity designed to ensure you weren't one of them has just been handed its walking papers. History is an unforgiving teacher. From the Gilded Age to the Roaring Twenties, and again in the lead-up to 2008, every major era of financial deregulation has followed the same arc. A short, intoxicated boom for the predators, followed by a catastrophic systemic bust for everyone else. We are now entering the boom of the predators. There is no cavalry coming to save your credit score or audit your mortgage. As of December 30, 2025, the responsibility for your survival has been fully privatized. You are now the CEO, the risk manager, and the sole security guard of your own financial life. The watchdog is dead.